And now, without further delay, let's begin today's event, sponsored by LexisNexis and Psionic, and hosted by American Banker. I'd like to introduce your moderator for today, and that is Mike Sisk. Mike, you have the floor.
Thank you very much, Adam. I'd like to welcome the audience and thank you for joining us today for a lively discussion on the key updates to the AML Act of 2020 and timelines for compliance with industry experts from LexisNexis Risk Solutions and Psionic. LexisNexis Risk Solutions harnesses the power of data and advanced analytics to provide insights that helps its clients reduce risk and improve decisions to benefit people around the globe. And Psionic is a global advisory firm focused exclusively on providing services to the financial services sector. And with us here today are leaders of its financial crime and compliance practice. And my name is Mike Sisk. I will be your moderator today. I am a contributing editor at American Banker. And I am very, very pleased to introduce our excellent panel today. Our speakers from LexisNexis Risk Solutions today are Chris Siddons and Daniel Poehler. Chris is a Senior Director of Financial Crime Compliance and has more than 20 years of experience, BSA, AML, OFAC compliance, and other risk regulations. Daniel is a Director of Financial Crime Compliance and is responsible for defining strategies in the United States and Canada that deliver innovative compliance technology combined with comprehensive financial intelligence. And Chris and Dan are joined by Joseph Cataldo and Bishi Nayak of Psionic. Joe is a managing partner at Psionic. He assists clients to tailor, implement, and remediate anti-money laundering solutions for their Know Your Customer and customer identification programs and due diligence programs. And Bishi drives strategic initiatives focused on enterprise risk management, anti-money laundering, and operational risks. These four gentlemen will provide an overview of the AMLA objectives, which include streamlining AML and counter-financing of terrorism laws, supporting improved coordination between government and industry groups, and encouraging adoption of risk-based AML CFT programs. So there you have it. It's going to be an excellent discussion today. And just before we jump into things wholeheartedly, I wanted to reiterate two quick things that Adam mentioned at the top. That is that we do have time at the end for Q&A. Usually set aside 10 or 15 minutes. You don't have to wait until the end to put your question into the queue. You can do that throughout the hour as it occurs to you. So please, ask away whenever the thought comes in your mind. Get that in the queue, and we will make every effort to get to your question in the time we have. If for some reason we don't get to a question you've asked today, we will definitely follow up. Your voice will be heard, so please ask away. And we also have a couple of polls today. And I always encourage 100% participation. We share the results live with everyone, and it's a great way for everyone on our program today to sort of see where other folks stand on the issue we've come together to discuss. So if you can weigh in on that poll when the time comes, please do. And with that, I think that brings me to the end of my little opening spiel here. I would now like to officially turn things over to Chris to get the ball rolling. Chris, the floor is yours.
Thank you. I'm actually going to defer to Dan. I think Dan's got some introductory comments, and then we'll move forward from there. Dan?
Yep. Thank you, Chris. Hello, everyone. It's great to be with you today. In this section, we'll discuss some of the key requirements of the Corporate Transparency Act. The Corporate Transparency Act mandates that FinCEN establish a centralized national registry of beneficial ownership information. Really, this is a result of the last FATF mutual evaluation, and is designed to end anonymous shell companies, which criminals have historically used to hide illicit funds. Individuals who have substantial control over the entity, such as the president or CEO, or those with at least 25% ownership, will be required to register their name, address, date of birth, and ID number, such as a driver's license or passport number. So how will this affect existing entities and new entities? Well, entities in existence before the effective date of the regulations will be required to report their beneficial ownership information within 2 years. And entities formed after the regulations are effective will be required to file their beneficial ownership information at the time their new entity is formed. The beneficial ownership registry excludes several types of reporting companies, which we've noted on this slide, including securities issuers, entities already required to disclose beneficial ownership, foreign exchange dealers, public accounting firms, pooled investments, and others noted here. These entities are governed by other regulations. As I've mentioned, FinCEN will establish, implement, and maintain the beneficial ownership registry. There will be limits on the use of the beneficial ownership registry, which we've outlined on this slide, and any breach of these use cases will result in civil and criminal penalties. I also wanted to point out that FinCEN's registry will minimize the impact at the individual state level, since each state will not be required to maintain a similar beneficial ownership database. Really, this puts the onus on the entity to ensure they're filing the appropriate documentation with FinCEN in a timely manner. Chris, from a timing perspective, do we have any insight into when these rules may take effect?
Absolutely, Dan, and I think the context here is similar to the conversation around how a bill becomes a law, right? It takes years for something to make its way through Congress, and then appropriately, once the act is passed, it takes years to make its way through government out into the public domain. So, we've got the AML Act passing in January. The reality is within 6 and 12 months, there's a variety of proposed rulemaking that's supposed to take place, some of which have already taken place, and Joe will talk about that in another section. And so specific to the Corporate Transparency Act, we've got at least till the end of the year before we see proposed regulations. There's a comment period, there's feedback, and the feedback and comments get oftentimes cycled into the final rule that gets proposed sometime beyond that. And within that final rule, generally there's an effective date at which time it becomes regulation. And so in this particular instance, once there's an effective date, there's a date at which the new entities in the market have to report to FinCEN, and FinCEN has a year to revise the existing CDD rule to incorporate the fact that there is now a beneficial owner registry that exists and new company formations are registering in. And then, of course, all these existing companies have 2 more years after the effective date of the registry in order to bring their companies current with the requirements. So we're really looking 3, 4, 5 years out before we actually see any meaningful activities that law enforcement can leverage in the investigation of criminal activities. And so I think it's important here to kind of think through this context in the context of other activities. And I think, Bisha, you've got some insights into kind of the international efforts or other countries' efforts to establish these beneficial owner registries.
That's correct, Chris. In fact, it's a complicated issue. Even if the regulators finalize the rulemaking process, by the time they put the infrastructure in place, it's going to take some time. Definitely, it's not going to be an overnight process. If you look at Europe, I think this process or this requirement was introduced as part of the AML Directive number 4. Even it was kind of reinforced as part of the AML Directive number 5 as well. And after a couple of years, if we look at the current state, out of the 27 countries we have in European Union, only half of them are behind schedule. And in fact, very few of them actually have a fully functioning process today. So, as you said, it's going to take definitely going to take some time. And you can, by the time the US regulations finalize the rules and put together all the infrastructure and mechanism in place where people can go and report the beneficial ownership requirement, that will be a while. So definitely we are talking about at least few years into this overall process.
Thank you, sir.
So this is Joe Cataldo speaking from Psionic. So I guess one of the key summary points, maybe just to kind of go back over the things we just talked about in the Corporate Transparency Act, is there really is no change to the existing rules and requirements around customer due diligence. In fact, if you look at the language here in the slide, the law makes that explicit. There is no change here. And I mean, to make it especially clear, a reporting entity is not a financial institution, right? So most of the folks on this call right now are not impacted as reporting entities. The only real long-term change that we can kind of anticipate is that the law does anticipate that financial institutions can use this beneficial ownership registry to simplify and streamline the CDD process if a company gives them permission to use that information. And how and why and wherefore of all of that, it's very, very early stages. As Chris just went through on the slide, we really have no early warnings about how that's going to happen. But, I mean, the summary from all of these slides really is that there's no immediate impact, and in the longer term, I think actually things may become a little easier around the CDD requirements if we can leverage this information. So that is a little bit about the Corporate Transparency Act. The next set of slides we have for you is to talk a little bit about the risk-based programs and how the Act impacts risk-based approach to AML and CFT. One of the key goals of the Act has been to reaffirm, make very explicit, and codify what has become a de facto standard in the industry, which is a risk-based approach to AML and CFT. And the source for the slides I'm about to switch into in a second is not only the Act itself, but also the advance notice of public rulemaking that FinCEN published in September of 2020, and comments were due back by November of 2020. So you can see by that kind of timeline that these advanced rulemaking proposals came out before the Act was signed into law. This law was signed in the beginning of January. But nonetheless, it really is part of a whole tapestry. It contemplates everything that's in the law, and they really work together, and you'll see that as we go through the slides. So one more just comment before I go into the next slide is that in the FinCEN advanced rulemaking, it really spends a fair amount of time. I think there's like about 5 pages in the advanced rulemaking proposal around the history of this de facto standard that we all live by now of a risk-based approach to AML-CFT. It goes through the history from the law, the BSA Act being signed in 1970, which had a very kind of prescriptive approach to AML, to the de facto standard we have right now of risk-based AML. And that's really an acknowledgement that one size doesn't fit all, that a retail bank is not a correspondent bank, that a private wealth firm is different from a corporate banking firm. And so the controls should be different and the approach should be different. And really what we're doing here in this law and the rulemaking is to formalize and codify that. So let's get into the slides. So the first item in the law that I wanted to highlight for everyone is there was this ambiguity in what does it mean to have a reasonably designed program. You could interpret that as reasonably designed to comply with the law or reasonably designed to actually detect and prevent money laundering and financing of terrorism. And the law now makes this very explicit. The higher bar is the expectation under the law now. The requirement and the expectation is that a reasonably designed program is a program that is designed to detect and prevent money laundering and financing of terrorism. And I thought this is a nice thing to highlight for everyone because on a personal note, many of us, I think most of us, are passionate about our jobs. We help fight financial crime. We help law enforcement stop truly bad actors from doing truly bad things. And we make the world a better place. So this change really speaks to me because, we're not here to check the boxes is what this says to me. We're here to really detect and prevent criminal activity. So that was the first item I wanted to highlight from the law. The next thing that's worth kind of highlighting is a definition of risk-based. And I think if any of us were to be asked what is a risk-based program, most of us would come up with most of this similar language, right? It doesn't change things in terms of what does a risk-based approach mean. One thing that's actually worth highlighting, if you look at that quote from the actual law, is the last phrase there, which is rather than low risk. So this is a nice change, right, which is that the law is acknowledging a reallocation of resources. Right? And FinCEN rulemaking, by the way, and you'll see this in a couple of slides, will echo this kind of approach, that there is an acknowledgement that to be risk-based, we not only focus on high risk, but we may allocate resources away from lower risk, non-productive activities. The other thing that's received, some fair amount of attention and consternation for, some of you on the call is this implication that we have to reshore our activities. And again, I try to take the language exactly from the law here. The law says remain performed by persons in the United States. Now, I guess the things to be aware of around this piece of the law is that it was added fairly late in the process, and people are not quite clear on what Congress's intent was in adding this language to the law. Also, the FinCEN advanced rulemaking has been completely silent on any requirement around reshoring your programs. So I think this is just something to keep an eye on right now. Really, it's too early to say what this means. And the other thing that's worth mentioning in the law is that it creates new functions within the Treasury Department. And the functions are really, again, intended to, and it kind of echoes the stuff I've talked about so far, improve coordination, help set priorities, and make coordination between law enforcement and the financial institutions that are reporting better. The other thing that's doing it is chartering Treasury to review the SR and CTR filing guidelines, and Bishi in a few moments is going to take us through some of those new requirements, or at least the expectations of what those new requirements will look like. So that is about the law itself. So now I'll switch to the advanced notice of public rulemaking that FinCEN published in September. And again, what you'll see here is that it echoes the priorities within the law. So it for example, defines what is an effective program. And again, I'll say that I think anyone on this call, if you were asked what is an effective risk-based program, you would come up with similar bullets, right? I think it would be something that you know, all of us wouldn't be surprised by what the rulemaking proposes. Again, one word to pay attention to is useful, right? Again, there's this kind of focus on improving the effectiveness of coordination between law enforcement and financial institutions, reporting institutions. Another thing that's worth noticing in the proposed rulemaking is it makes explicit, or at least proposes to make explicit, a risk assessment, right? So again, this is one of these de facto standards that most banks and financial institutions are following, of conducting a risk assessment. If you look at the FFIEC manual, it'll say, while not, we were just looking at this prior to the call, while not an explicit requirement, a sound AML program has a risk assessment as part of its basis. So most of us are doing this, but now what the FinCEN proposed rulemaking is saying is, let's make this explicit. Everyone must do it. It makes explicit also that the Treasury's priorities should be part of your risk-based program. And again, it acknowledges, and again, this is echoing the language in the law, it is echoing the law by saying that an effective program may mean reallocating resources from lower to higher priority tasks. So that's a little bit about risk-based AML CFT programs. I'll advance the slide and turn it over to Mike.
Excellent, excellent. Yes, everyone, our first of three polls here as promised. So I'm just going to, way this is work, I'm just going to read out the question, pretty much a yes or no question answer here, give everyone a little time to make their selection, and then we'll share the results with everyone. So are your AML operations impacted if the rulemaking requires reshoring? And we'd be at a yes, somewhat, no, or you're not sure. That, although I have did I interrupt, or did you jump in and say something?
Well, I guess I was just going to fill the air while people click, so that, again, where I think we are right now is that we really don't have a clear intent around what the language says, and we really don't feel comfortable right now whether we understand if this is the implication of the law, or was this something that language was perhaps not crafted exactly precisely enough. And again, FinCEN hasn't come out with any rules around this. So it really is early to say, and it's really, if you have an impact here, it's definitely worth you keeping an eye on what the rulemaking that comes out from FinCEN says about this. But Psionic and LexisNexis, I think, as well, are not advising any actions right now if you do use non-U.S. resources for the implementation of your AML programs.
Joe, there was a question about what reshoring means. I wonder maybe that would help if we defined reshoring. But
yeah. Sorry for using a term that confused it. Yeah, so it basically, so that the law is saying that the program must remain, and that word remain is actually relevant, must remain conducted by persons in the United States. So then if you have folks who are doing, for example, working of alerts or running your program that are not in the United States, the implication could be that you need to bring those folks back into the United States. So if you're using offshore resources, you'd need to bring them into the United States to do that work. Now, interestingly enough, I highlighted the word remain because that word implies that there's no change, right? So again, it's ambiguous, and we need to hear what FinCEN has to say about this.
The results are up there for everyone to see now, correct?
Yes, I can see them. Yeah.
Yep, excellent.
So I think that's all I have to say about this item. I think we
good.
Can, we can advance
along here. Very good. I'll push it to the next slide here, and I think is she going to?
Thank you, Mike.
Yes.
Yeah, let's talk about the regulatory reporting, right? So as all of us are aware, the regulatory reporting is kind of a significant portion of the overall AML program that each of these financial institutions have to put together. In fact, FinCEN's study has shown on an average the firm spends around 28% actually of their overall the AML program cost just for the regulatory reporting purpose. Now, if you look at historically, there have been three major concerns around this whole regulatory reporting framework that we have in place today. First of all, transparency. As you know that probably the regulatory reports are the linkage between the financial institution and probably the law enforcement agencies. But the financial institution actually do not get any kind of feedback on the nature of the information or, which is a bad SAR versus which is a good SAR or what the information was helpful or not helpful. They do not get any kind of feedback from either from the regulators or from the law enforcement agencies on that. Second is the nature of information. As we know that this reporting mechanism or the framework was put together probably decades back. Now, when you are in the 2021 time frame, there is always a question comes in: do we need to kind of revisit the reporting mechanism, or there is some kind of modifications should be done on this front? Third, there is a question around the thresholds. As you might, as you might know, the SAR had a threshold of $5,000, which was put in place back in 1996. If we look at the currency transaction report, the CTR, the $10,000 thresholds we have was put in place back in 1970. If we do a simple, inflation-based adjustment of the $10,000 limit for the CTR, in today's market, probably it will be more than $60,000. And obviously, those days we did not have virtual currencies or bitcoins or digital payments, in those days. Let's talk about how this AML Act of 2020 actually is focusing on the regulatory reporting. In fact, if you look at the language of the law, the 2020 rule actually try to address all these fundamental concerns we have over the period of time. So when you talk about the transparency to the financial institution, the regulators actually request now to provide a semi-annual feedback to the financial institution in terms of the effectiveness, the trending, as well as some kind of typology-based feedback to the financial institutions. Obviously, the financial institution would be able to know the impact of their reports, how they have submitted, and what kind of information was useful versus what was not being useful, and try to adjust their program accordingly. Similarly, if you look at the nature of information, as part of the modernization initiative, the regulators now would be required to review the information that's been shared as part of the regulatory reports and try to make necessary modification as appropriate. When you talk about the thresholds, actually there is a clear language on the AML Act 2020 which requires the regulators to review the thresholds and revise as required. Now, FinCEN has done some studies on that. If you look at the current thresholds for the CTR, if they move the CTR threshold from $10,000 to $20,000, they're expecting almost a 65% drop in the number of CTRs that's been filed by the financial institutions. Similarly, if we look at the SARS, if the current transaction limit of $5,000 moved up to $10,000, they're expecting a 21% drop in the number of SARS being filed by the financial institution. And this, of course, is a kind of a positive news for many of the financial institutions, considering the effort and the cost involved as part of the regulatory reporting process. But there is a pushback from the law enforcement agency also in terms of losing out the granularity of the information. They fear the risk of losing the details of the information, as well as losing out substantial pieces of information that they may get as part of the regulatory, as part of the financial forms. So we have to see in terms of how the final rulemaking is happening and what is the impact and what are the actual changes that's going to take place. But considering the language of the AML Act 2020, definitely we are going to see some changes around this area in the coming months. The other aspect, if we look at again the AML Act, it talks about the sharing of information. Now, specifically for global institutions have offices around the world, it's always a question of, what information you can share between your offices, which information can be shared with the head offices. It's always kind of a trivial question that, goes with the global institutions. And it's a complicated issue as well as a delicate issue, considering, we have to go through a lot of jurisdictions as well as there's a privacy rule, there are PII-related rules. So it becomes very tricky in terms of what information you can share across the boundary, as well as what information can be shared potentially with the head office or to the branch offices you have overseas. At this point, there is a thought process that the foreign branches who are operating in the U.S., most likely they will be allowed to share their information with the head office. On the contrary, if you're a U.S.-based entity and have foreign-based branches, you may not be allowed to share information if your branches are operating in countries like Russia or countries like China or any of these so-called state-sponsored terrorism. So as far as, again, the AML Act 2020 is concerned, it clearly lays out guidelines for the regulators to provide details as well as clarity in terms of what information can be shared and what information cannot be shared, if you have branches or offices outside of the United States. The other component the rule talks about is the virtual currencies. As we all know, in today's world, virtual currency is kind of the reality. Every other financial institution has to kind of deal with the new age currency, which is, the virtual currency, the digital wallet, the bitcoins. Now, in the rule, actually, it lays out some guidelines for the regulators to consider the virtual currencies very similar to cash transactions. So when you talk about any kind of your requirement around reporting requirement or record-keeping requirement for the cash activities, those all would be applicable to the virtual currencies as well. Now, if you look at the AML Act 2020, it's actually on an overall try to address the fundamental concerns that we had over the period of time and tries to kind of spell out very clear language for the regulators to provide new guidance as well as new regulations for those. And considering the amount of importance and the amount of details that have been provided in the Act, we are definitely going to see a number of changes specifically around the reporting framework, both on the SAR front as well as CTR and, for that matter, any of the regulatory reporting we're talking about. I think that's all we wanted to cover as part of the regulatory reporting. Now, another component we have on the AML Act 2020 was around the model risk management. And I know, Chris, you have some good observations on this.
Yep, I think thank you, Bishi. I think I actually take us first here. So thank you. We're going to go through a couple things here. So we'd like to spend some time discussing the impact the AML Act will have on model risk management. And really what we're going to do is break this down into some questions and answers that we think you guys will find really helpful. So what does this mean? What does all this mean? The AML Act will codify requirements for development, implementation, and use of compliance technology, including machine learning, artificial intelligence, and all this is sort of outlined on the next couple of slides. I know that I hear a lot about machine learning and AI in the industry today, so these requirements will be really important for everyone to understand. Much of the law focuses on things we could miss or fail to adequately challenge during testing and implementation. This is especially true since a lot of these new technologies will result in cost savings to your organization. So, Chris, we have a lot of bankers on with us today, and many of these folks may have already passed examinations related to these systems and processes in the past. And I'd like to think that none of what's noted here is difficult, but it's also not magic. It will require adequate planning, evaluation, and end-to-end operational risk execution. Could you provide some thoughts on how these requirements will impact the bankers that are on with us today?
Thanks, Dan. I think that you're right. These are not difficult and they're not magic. And I would actually argue that for the past 10 years, most of the large global financial institutions have been already contending with this, and they already have strong internal control environments to address the supervisory guidance on model risk management that the regulators published back in 2011. Those FIs that are based in the state of New York have had some state-level regulations published around a similar topic with Rule 504 published by the New York Department of Financial Services. So I think overall we're going to find that there's a lot of work that's already been done in this space. I think where it begins to become challenging for the industry is where maybe the regulators have not, or the auditors or model validation teams and organizations may not have paid as much attention to an AML or list screening technology or machine learning type of tool that overlays and improves on some of these basic functions, where they haven't necessarily developed a strong internal control framework. They may not have been classified as models, or they've been kind of a lower tier model. And so the rigor has not been as robust. And I think what we'll find is there's some retrofitting that takes place. And we can talk a little bit more about that later in some of the subsequent slides. But I think overall it's going to be a relatively simple migration from guidance to law. I think the big concern is it will not have force of law. And so if somebody doesn't actually have these internal controls in place, that can warrant an exam finding, and it carries a violation status. They don't have to fail to file SARS. They don't have to fail to identify a sanctioned transaction. They actually now have just failed because they don't have a robust internal control framework, which is now a legal requirement. Dan, are you still there?
I'm sorry. Yes, I apologize. Yes. So as a practitioner and vendor over the years, I've seen scenarios where a new compliance team may inherit an existing screening compliance process. The new team may not ask adequate questions about how the system or processes work, or even if the results are effective. So what impact will the requirements have on a scenario just like that, Chris?
Okay, so where somebody's coming in and they're inheriting an existing or long-standing program, right? The reality is if I'm coming in as a new AML officer or leader in an organization, there's one thing I always want to do. I never want to make assumptions. I want to assume that my predecessor has done a good job. but I'm not going to assume that there weren't blind spots. And so the first step is always, let's get an independent assessment in place. Let's do a review of the exam findings, the audit findings, and any model validation findings. And let's get somebody like Joe involved and get that kind of third-party, external, independent-minded person to take a really hard look at it and evaluate, are we doing things well? Are there any things that we might have had blind spots in the past that are kind of those skeletons in the closet? Those are the things I'll worry about. The things that are written, the things that are established where I can see the evidence that they're working well, those don't keep me up at night. It's the things that maybe aren't going to the level of granularity, or I can't find somebody who has the answers readily available. Those are the things that are going to keep me awake at night. And so it's important to get that independent assessment in very quickly. And I think the other thing to do is look at what we have, particularly in the model risk management space around screening tools and transaction monitoring tools. Do I have the appropriate internal control framework in place? And let me go back to my guidance. Let me go back to my Rule 504. Do I have documented policies and procedures and internal controls in my operations that are evidence that these things were performed in the implementation of the tools that I'm inheriting?
Thank you. Just have an interesting sort of follow-on to that. So, but how can the bankers with limited compliance staff and limited technology resources handle what you just described, but especially during the COVID pandemic? I think, Chris, maybe Joe and Bishi may have a thought on that too, but, it's really timely with COVID going on.
Yeah, I think so, and I'm gonna address two dimensions of that, and part of it is prompted by the questions coming in. First off, for all intents and purposes, many institutions, remote work, remoteness of people is not an impediment to doing a lot of this work. Our teams, Joe's team, I'm sure, and certainly within LexisNexis, our professional services group, we haven't missed a beat. The bigger hurdle is less about the co-location of personnel, and it's more around, do we have good information security and data privacy controls around the exchange of data sets that are used in order to test, validate, and execute these control frameworks around transaction monitoring and AML, lift screening platforms and these machine learning models. That seems to be the hurdle that's hardest and most time consuming to overcome. Once that's overcome, it's really kind of business as usual. Now that said, what I think there is a challenge in many organizations around getting leadership to sign off on the expenses and the investment necessary in order to put the proper controls around these technologies, either going back to retrofit, which I think that problem will get solved very shortly when the proposed rules come out and we have a real good bullseye to put in front of our leadership. But even in new technology coming in, if anybody's in the situation where this year they're putting in new models, they're implementing a new list screening or transaction monitoring tool, the reality is you want to take these pieces of legislation, you want to take the guidance from the federal regulators, you want to take the Rule 504 legislation in the state of New York, you want to say, look, guys, here's the blueprint for what we expect to come out from FinCEN this year in the proposed rulemaking. These are the guideposts, right? These are the things that say we're 1,000 miles from London or whatever. But those are things that you can key off of, and you can begin socializing the incremental investment necessary in your organizations today. Joe and Bishi, do you have some additional thoughts around that from just how people can begin evaluating their existing frameworks?
So no, I think you've given a really nice summary, Chris. It's I think a good overview of kind of what the expected rules will look like. I mean, I think if you're going to look at what is the real canary in the coal mine, I think it's like, as you say, DFS 504, and the other thing is the Office of Comptroller of Currency has put out this SR 11.7 rule that talks about model risk management, not within the context of financial crime, but in general in a financial institution. And I think that it's very likely that the guidance that we're going to get in the proposed rulemaking is going to echo that approach. I mean, I guess the other thing that I'll just maybe comment on is that I think it's expected that the controls are fit for purpose. And so if you have a one-person small, AML operation, in a small credit, regional credit union versus, a multinational tier one institution with hundreds or even thousands of people, there's obviously an expectation that's different from the regulators. And if you look at the model risk management guidance from the OCC, it reflects that as well.
Yeah, in fact, if I can add just another point, right? I think there is a discussion that the DFS 504 will not be a New York state matter anymore. I think, there is a strong thought process that this might become the, more of a regulatory expectation across the country as well.
Thank you, Bishi. So I think we have some great information on this slide, but maybe, Chris, to sum up, what should the bankers on that call do to prepare for the upcoming proposed rulemaking? I don't know if you have any thoughts on that.
Sure. So if I'm not in a situation where I'm based in New York, or I've got a long-standing, painful experience that has matured well in kind of the federal guidance and implementing that around my AML and sanctions screening technologies, the starting point for me is always go back to those guideposts. Let's distill those guideposts down into operational controls, because really everything about those two pieces of guidance and legislation, respectively, is really around how do I take the failures that have existed in processes. Either we've underfunded the technology team. Our greatest experience that we all share is I spend a year on technology implementation, and then I have testing week, right? It was supposed to be 3 months. Now it's a week because things inevitably get delayed. People aren't available. And the reality is that's where we fail, right? So going back and saying, all right, what do these things really mean if I put them in procedures? What do they mean in evaluating my system? So a good example in list screening, do I truly understand the way that system is designed? Do I understand the predicate assumptions on the 10, 20 data attributes that I'm putting into the system? And if I understand those assumptions, have I done a data quality assessment to ensure that my data actually fits those assumptions? It's no different than putting gas and oil in a car. If I put bad gas or poor quality gas in my car, that engine's going to clog and it's going to degrade performance over time. It's the same thing with internal controls and planning around data going into transaction monitoring and list screening systems. So take a hard look at that. And you've got resources you can apply. You can call our folks. You can call Joe's folks. We've got people to help people through that. But a lot of it is really taking all that conceptual framework and distilling it down to discrete actions to manage the risk that I'm putting bad gas in my engine, which is really what it boils down to in its simplest form. Joe, do you have anything you want to add to that before we move to the polling question?
No, I think that was a good summary. I think we can switch to the polling question.
Excellent. This is Mike. I'm going to jump back in here, and so here is our second poll, and we'll run. I know we're getting to the top of the hour here, so we'll run through this pretty quickly. Is your AML program prepared for new regulations? That are the same 4 possible answers here: yes, somewhat, no, or not sure. a lot of questions in the audience, so I want to thank everyone for asking those.
And I think, Mike, while people are actually responding, I can take one of the questions because I think it's relevant to this segment.
Okay.
Somebody asked if they could rely on model validation activities to kind of fulfill the expectations or requirements that are likely to develop. And my initial reaction is probably not. Model validation is an internal control. It's really something that's done at the end to help validate that you've done all the predicate controls. And so typically, if I think about our experience in the world I live in, I've been on the other side. Now I work for a vendor. Most of the calls that I've gotten engaged in with clients who have gone through validation, or they're in a regulatory exam, or they're in an internal audit of their program, somebody's done the validation testing and say, oh my gosh, you missed all these tests. Well, the reality is, if you've got your internal control framework in place that got you to your implementation, there shouldn't ever be an issue in your validation, because you should be able to explain your risk profile, the way the system is designed, the assumptions inherent in the design of that system, how that impacts the data selections you made on what data you're putting into the system, and then ultimately you will have formulated a risk-based decision of, I'm willing to accept X inherent risk that I'm going to miss, and I'll use OFAC as an example here. I'm going to take a certain level of risk that I'm going to miss a potential violation, right? Because for one potential violation, I'm not going to spend an extra $1 million every year in overhead to catch one thing that might happen when I've got a low-risk profile. And those are risk appetite decisions that get made through the supporting data analysis in those upfront controls. So I hope I've answered the question that was posed there. But model validation is kind of the tail end of the spectrum of the internal control framework around these systems, not something you would rely on to evidence that you've made good decisions up front.
Excellent, thank you. And here I've popped up these results here, and as you can see, about 25% of the respondents here are confident that they are prepared for the new regulations. And is there anything that someone would like to add on those, or should I move along here?
Well, I think that would play out with what we'd expect to see. I think, you know, the model risk management stuff, you know, as a compliance person, I probably spent several months kind of reading the rules and trying to figure out, okay, well, how does that translate into my world? And so it can be easy if you kind of have that mindset, but for many of us, you know, it's a heavy lift, right? Because you have highly conceptual things that you're trying to distill down into the operational actions. And then when you start getting into data analytics, there's really a village of skills that are needed to really execute the internal control framework that's expected around these tools. And the smaller the organization, the harder it is to create that village of skills that's able to support that. So I think those results are highly expected. So we've provided a list of links here. You know, if you're downloading the content, you've got the Notice of Proposed Rulemakings, you've got the AML statutes as well. And then, you know, it's easy to find the guidance documents that are referred to in the other slides. So, you know, hopefully everybody finds this helpful before we kind of move to the Q&A session here.
Excellent, excellent, thank you. So let's